Welcome back. All right, now let's take a look at goodwill and how do we deal with impairment for goodwill. So what we have is our four main things on the side, as usual. We're going to start with asset grouping. And asset grouping for goodwill is done what they call at the reporting unit level. Okay, so I want to give you a little explanation of what this is. So let's say A buys B, and B, that company, has two main divisions. They do electronics, and they also run a bunch of restaurants. So clearly we have two different segments, operating segments, and when they bought B, they did all the calculations and they found that the goodwill was $100 million for the entirety. What we're required to do by GAAP is to designate that goodwill at the time of purchase to the fair share to each of the units, right? So based on the appraisals and the calculations and the forecasts and the underlying value of each of these segments, then we have some way of allocating that and being able to assign that $100 million to each of the parts. So I'm going to say that the electronics gets $40 million and that the restaurants get $60 million. Okay, so that's what it means. And in order to be at this reporting unit level, GAAP requires three things. It's called an operating segment. There has to be, one whole part makes revenue and incurs expenses. You have a CEO or manager, divisional manager that oversees that unit, and then finally there is discrete financial information that can be pulled to evaluate each of the units. So that's what's required to be an operating segment. So that's how we deal with it. It's at the reporting unit level. So let's take a look now at these other three. Similar to the indefinite life intangibles, we test annually. It doesn't have to be done at the exact end of the year. You can do it at any point during the year. It can be done either a qualitative test or a quantitative test. And again, the qualitative test, you look at a group of factors. Quantitative test is required if it's more likely than not that there's been an impairment. So if you're going to do a quantitative test, this is a big deal because what we're going to need is we have the book value of the whole unit, right? Because we have the books. But do we have the fair value of everything? And can you imagine, depending on how many assets there are and if there's intangibles involved, how difficult that might be? So companies are more likely to opt for the qualitative test, but once they get here, quantitative test, that's going to require some cost in the company to come in and get all those fair values. Okay, so once we do have it, assuming we have it, it's a one step. It's a book value of the unit minus the fair value of the unit. And then if this is positive, then we say we got an impairment. But there is a constraint here, and you are limited to the amount of goodwill that's on the books. I'm going to walk through an example in a minute, two different cases, and we'll see how the constraint comes into effect. And finally, once we have an impairment, we will be using the fair value. After the journal entry, we'll use the new goodwill amount, and I'll talk about that a little bit in our example. So that's all it is. There's our 4 steps. And again, US GAAP does not allow you to revalue goodwill, but IFRS does to some extent. All right, so let's take a look at our calculations and see this in action. So here's case 1. What we have is the actual unit, and they provide us the book value of the net assets excluding goodwill. And then they show us the book value of goodwill by itself. We need that information in order for us to make the journal entry. We'll see that in a minute. So the book value of the total reporting unit is the combination of the two, so I simply added those up. Now somehow we got an appraisal done. We found out that the fair value of the reporting unit, including goodwill, is $800,000. Okay, so in order to do our test, we're going to simply take book value, subtract out fair value. All right, so let's do that. All right, so we simply did the calculation, book value minus fair value. We came up to $100,000 as an impairment loss. I took a look at the book value of goodwill. Goodwill has $200,000 in it. So that's okay, the constraint is met. We cannot go over 200,000 in our journal entry because we can't have a negative amount as our asset. All right, so 100,000 we're fine. I just simply did the journal entry, debiting the impairment loss, crediting goodwill. Goodwill's value after this will be $100,000, and that's where it's going to stay unless we have further impairments. So now we're going to take a look at case 2, where things are a little different. So in this case, what we've done is change the fair value of the reporting unit. So this is still at 900,000, but the fair value of the reporting unit only 500. So we did a qualitative test. It appears that we've had an impairment. We go ahead and we do the quantitative test here. Book value minus fair value. These both include goodwill. That comes out to 400,000. So it looks like we have a potential impairment loss of 400,000. Well, we know we're going to have to do a journal entry, and so the impairment loss is here. But notice I only have the amount 200,000. The reason? My book value of goodwill is 200,000. So I cannot take that impairment of 400 because I have to just deplete what's in goodwill and stop at that point. So there's my journal entry. Goodwill I credit for 200,000. So after this entry, goodwill has a balance of 0, and that's where it's going to stay. Okay? Now I'm just going to give you a little context here, is that US GAAP has really struggled with the accounting for goodwill, and we used to amortize it. We used to have a different test for dealing with the impairment, and then we've come up with a more simplified test. At this point, private companies, they actually are allowed to amortize goodwill, and guess what? FASB is now looking again at goodwill. So expect this to continue to evolve, and the reason? Cost, the cost constraint of providing this information. And when it came to private companies, the actual gathering of the information to get that assessment done to find the fair value may be enough to bankrupt the company. So if a company's already struggled, they have the goodwill impairment, you don't want it just to go under because they had to pay an appraiser and get all those fair values together. So it's kind of a nice rule for private companies that they can amortize it, and they still would have to check for impairments, but it's less likely to occur because it's been amortizing over its life. All right, so, US GAAP, IFRS, they're always evolving. You got to stay on your toes. All right, I'll see you next time.